Okay, today's segment is something I have been waiting to be able to do. My guest, a CPA, he's been all tied up and doing tax returns, and I couldn't get him on until after October 15th. But we're going to talk about the big, beautiful bill, and we're going to talk about some very practical things that if you run and own a company, you need to know. It'll save you some money, so stay with us. All right, welcome to Nabity on Business. Dave Nabity here. I have a special guest, Doug Morris, that has joined me. Doug, welcome. Glad to have you here.
Yeah, thank you, Dave, for having me.
He's with McFarland and Brocky, CPA firm.
You got it.
And why isn't your name on the banner anyway?
We're frugal CPAs. We don't want to spend the money
to
change all the signage.
Your logo might cost too much to change your logo.
Yeah, we could use the deduction though, maybe.
Yeah. Now, you didn't get the memo that said that you're supposed to wear a red shirt with blue stripes.
Yeah, not today.
We both got white shirts on today. If I'd known you were going to be that tighty-whitey, I would have probably worn something different.
I think we look good, yeah.
Yeah, all right. Look like the Blues Brothers is
right.
What we look like.
There you go. So
anyway, Doug is a CPA. He's one of my favorite CPAs. We do a lot of work together, and I'm kind of amazed he even showed up on the show knowing what my tax return looks like and all the high maintenance stuff that we put him through. But I wanted to talk about the big, beautiful bill. And just from a business planning standpoint, Doug, what do you suppose are like some of the key things that business owners can take away from the new bill?
Yeah. So the one big, beautiful bill, I'm super excited about. It renewed many of the tax provisions of the Tax Cuts and Jobs Act, and it gave us
that act was when?
That was in 2018 when that passed.
Is that right? Okay.
Yeah, and it was set to sunset at the end of 2026. So one big, beautiful bill basically stepped in before it expired and revised, made permanent, renewed a good amount of the provisions that the Tax Cuts and Jobs Act initially laid out.
If Biden had been in there, or if Kamala had one, you could bet this bill would have never.
It definitely feels like Congress would have been a little bit more divided for sure.
Yeah. Well, I mean, one of the big things is the change in the federal estate tax.
Absolutely.
Right? And the Democrats are always going after the people that they view as wealthy.
Sure.
Why don't you talk a minute about what change there was there?
Yeah, so the estate tax was a large one. The estate tax has now been increased to $15 million.
Per spouse.
Per spouse. So if you are married and you have a spouse that passes away and they don't use their estate exemption, you can file what's called a portability election, and you can use or transfer your deceased spouse's unused exemption to yourself. In layman's terms, yeah, it's basically a married couple gets a $30 million exemption instead. Now, absent the one big beautiful bill raising that to $15 million for a single taxpayer, $30 million for married, the estate tax is significant. If you die and your estate's valued at more than those amounts, God, the estate tax is 40+%.
Yeah, you got the state at 1 and the federal at 40. What would it have gone back to if they hadn't changed it? I think it was like $7,500 a person, if I remember.
Or
right.
7.5 million.
Yeah, that's what I meant.
Yeah, absolutely. Yeah, it initially was slotted at 6 million, and it had been inflation adjusted upward. But I think you remember incorrectly that it was slotted to just stay at 7.5.
So it's also my understanding that there'll be inflation adjustments on that 30 million. So.
Yeah, typically there absolutely are, which makes my life a little bit hard in the tax code because it makes the numbers harder to remember. Nevertheless, I appreciate the inflation adjustments.
Well, one of the things that we try to do when we're helping clients with their estate planning is making sure that if you take a snapshot of what the estate looks like today, getting a realistic idea of what the growth is going to look like.
Absolutely.
Because if the growth in the estate exceeds the inflation rate on the adjustment, then you are going to end up paying some estate taxes down the road, even if you're not paying any today, if you just look at it today.
Absolutely. Yeah, I'm sure we both agree that planning is very important. And a very easy estate plan is that if you've got clients that you think will be close to that estate limit by the time that they and their spouse pass away, gifting assets during lifetime out of the estate would be a great idea, especially the assets that you think would be highly appreciated. The IRS says that you can, at least for tax year 2025, this gets inflation adjusted as well, but maybe not as quickly or as regularly. You can gift up to $19,000 per person to get that estate down without any additional reporting requirements and without any reduction to that estate exemption amount.
So you're saying gifting to your children,
first and
assuming
foremost,
you have children,
right?
Yeah, I'd much rather see assets go into a donor advised fund
Absolutely.
or a charitable foundation instead of money going to the federal government if you don't have kids. But
sure.
What just one more thing on this. A lot of people don't realize that their business could make up 60, 70% of their estate.
Absolutely.
And the business is profitable and kicking off all sorts of money on an annual basis. The dumbest thing you could do is ignore the estate tax and then have mom and dad gone and have to sell the company just to pay the doggone tax.
Absolutely.
So a whole bunch of things you could do ahead of time.
Right. And then when you sell, then income tax kicks in. I laugh in my world about all the different tax types that are out there, but the estate tax kicks in. At least in our state of Nebraska, we've got a local inheritance tax that kicks in. We've got income tax that kicks in. It all goes
Capital
sideways
gain
quick.
taxes. Yeah.
Absent planning, anyway.
Well, okay. So let's talk about the income tax aspects of the new bill.
Absolutely.
Go ahead. Give me your summary as far as some of the good things that have happened.
Yeah, so you asked me earlier some of the bigger items of One Big Beautiful Bill. I'll start with some of the smaller ones first, but genuinely do have a bigger impact. So as part of the extension of the Tax Cuts and Jobs Act, the tax brackets remained where they were. And so
were they set to go up quite a bit?
So prior to the Tax Cuts and Jobs Act, the tax rates were much higher. If I'm cheating, looking at my notes.
Go ahead, look.
Quick.
Yeah,
Absolutely.
I got plenty of papers here too. So,
so the tax brackets at the federal level are 10%, which would have stayed at 10, 12%, which would have reverted back to 15%, 22%, which would have went to 24, 24, which would have went to 25, 32 to 33, 35 stays at 35, and then the last one is 37, which would have reverted back to 39.6. Now, contrary to popular belief, I heard quite a bit that, it doesn't impact me. The tax brackets shouldn't have all that big of effect, but the tax buckets are progressive, and so your first, say, depending on if you're single, married, or head of household, your first, say, $20,000 to $40,000 is in that 10% bracket. But as soon as you cross that into the 12% bracket, you immediately see savings because the old bracket would have been 15. So you're already saving that 3% that it would have been. And then you graduate into the 22 that would have been 24. You get where I'm going. The tax brackets staying where they are instead of reverting back to the higher rates is lower end tax bills for everybody, pretty universally.
Yeah. Now, I hear this all the time from clients that said, the equipment that I used to have to depreciate over a period of time, now I can write all of it off in the first year.
Yeah, so jump into one of the bigger changes of the tax or of the One Big Beautiful Bill is bonus depreciation. Bonus depreciation, when the Tax Cuts and Jobs Act went into play, said that if you have a fixed asset of your business, think a table, furniture, equipment, a heavy vehicle, hell, even a rental property, if you will, fixed assets that you purchase, the IRS said that anything that has a depreciable life of 20 years or less is eligible for what's called bonus depreciation. Prior to the One Big Beautiful Bill making bonus depreciation 100%, which, by the way, just means that if I bought a truck that's at least 6,000 pounds, or I bought a piece of equipment, and let's just say I bought it for, say, $10,000, bonus depreciation says I can write off that entire $10,000 in the year I purchased and put that asset into service. Prior to One Big Beautiful Bill, there was a gradual decline of bonus depreciation. So for tax year 2025, for example, bonus depreciation was only set to be 40%. So in that same example, if you bought a new piece of equipment for $10,000, One Big Beautiful Bill says I can write off 100% of it. So prior to that, it would have been $4,000.
Let's say you got a company that has a bunch of dump trucks.
Absolutely.
And they have to keep replacing those dump trucks. And if they had more dump trucks, they could maybe do more business. So that's that catch of, do I go ahead and borrow the money and buy the dump truck and expense it right away? And I got old stuff that I have to replace. I have a client, they went from, maybe paying tax on X amount a year to paying no tax because their bonus depreciation completely offset their taxable income.
Absolutely.
And the thing is that looks amazing on paper, but you have to factor in the cash that has to be paid every year on the principal payments on the equipment you just bought.
Absolutely, you do.
And most people just won't pay cash for that stuff. It's better off to spread it.
Yeah, finance it.
Yeah, to finance it. So if you're replacing dump trucks, you might not pay any tax, but you might be chewing up a bunch of your free cash flow.
Yeah, it's definitely a balance. So at least on the tax piece, we like to do a mid-year and end-of-year planning with our clients, and I know you do with yours as well. And One Big Beautiful Bill, especially now that we can bonus depreciate dump trucks, as an example, oftentimes what we'll do is we'll forecast where we think your taxable income is going to be and make a decision with the business owner that says, hey, if you owe $100,000, and let's say you're in a 25% tax bracket, so more than likely your taxable income's $400,000. If we bought $400,000 worth of new dump trucks, claim bonus depreciation, we could get you to zero. So from a tax perspective, it's very, I don't want to say easy because there are other options and other considerations like cash flow needs. But it's an easy recommendation on the tax side to go, yeah, let's go buy 5 dump trucks and get to that $400,000 worth of deductions. But the trade-off absolutely is part 2 going, if we write them all off in year 1 and we've got a 5-year note on these dump trucks and I can't write them off year 2, year 3, year 4, year 5 because I already wrote them off in year 1.
You might have to keep buying dump trucks to not pay taxes.
Absolutely,
right?
You might, yeah.
So that's what I'm saying. If you got old ones that are aging out. Now, what's the story? Let's say you buy the dump truck and you keep it for 5 years and in year 6 you sell it.
Yeah, you have to recapture the depreciation to the extent you sold it for. So if you bought a dump truck for, say, $80,000 and we bonus depreciated it, and now it's on the books at zero. You've got $80,000 that you paid for it, $80,000 of accumulated depreciation that you've claimed on it. If you then said, hey, in 5 years I sold it for $50,000, I do have a $50,000 gain that I have to recapture as income in the year that I sell it, which does to some degree put you in this cycle of, okay, well, I better buy another dump truck then.
Yeah.
So it's a great note.
Is there a sweet spot there that if you get past that sweet spot is like Armageddon as far as cash flow and taxes? If you don't, let's say you don't buy, you sell these, but you don't buy. I guess I don't know if that would ever really happen if you were staying in an active business. You'd have to keep replacing equipment you sold.
You're absolutely spot on. So the 2 comments that I'd make on that are number 1, I'm a big believer in don't spend money just to get a tax deduction. If you need dump trucks, in this example, if you need some sort of fixed asset, really tax planning in my mind is when should we buy it? Should we buy it December 31st or should we buy it January 1st? So
that's where your expertise comes in, right? Because you can kind of set the radar screen up for everything going on and then figure out how to time that. I know you've done that with me quite a bit, which has been really helpful.
My running joke tends to be, though, Dave, if you're looking for a tax deduction, I can send somebody an invoice tomorrow. Right. But so that the first point I'd make is don't spend money for tax deductions just because. Spend it on things that your business actually needs. If the dump truck you need because it's going to make you more money, we can help you figure out when to do it. But the second comment absolutely becomes a lot of tax strategies are short-term and long-term, or sometimes short-term versus long-term, and they're competing. I do get a lot of people that are very allergic to tax. They don't want to pay any tax. And part of the strategy is, okay, well, we'll buy four new pieces of assets that will bonus depreciate, and we'll kick the can. Or we'll buy a new piece of real estate, and we'll do a cost segregation study and claim bonus depreciation on the real property. And again, we kick the can. But the can could come due at some point. Now, in the best estate plans, the people that I've seen from start to finish, at death, there's a great tax law that pairs well with the estate exemption being as high as it is, and that tax law is stepped up basis. And so one very long-term legacy planning item that we get involved with is, if you've got property, if you've got equipment, and you've just significantly depreciated it, maybe it's worth nothing on paper because you've depreciated your entire cost. If you die with that property, your beneficiaries at your death get a step up in that basis equal to the fair market value of those assets at your date of death. And we get to wash our hands of recapturing any of that depreciation. Very, very long-term strategy play.
Well, in a family-run company, though, that's got to go in the mix because,
Absolutely.
If you do everything to avoid estate taxes and do all sorts of gifting, the basis of the grantor stays the same for whoever it is that inherits the asset. If they keep it until they die, then there's a step up in basis. If the kids inherited it, they can go ahead and sell it, and they don't have to pay any gain.
Yeah, they don't worry about the tax.
Yeah, so it's
another nice part of this one big beautiful bill that pairs well with an existing tax law, though. If they hold it, we get stepped up basis, and if the value of those assets stays under $15 million for single, $30 million for joint taxpayers, I don't have any wealth-based tax on asset worth, that aka the estate tax, and I don't have much of an income tax concern for assets that now get stepped up to fair market value, and my basics gets replenished.
The one thing I've noticed with this is I will start working with the client, and I'll initially think, mom and dad should just hold on to this for that reason. But what I see happening is the next generation, they want to own something now.
Sure.
You know what I mean?
Absolutely.
There's something about working and just getting your W-2 wage, not being able to take distributions for yourself.
Sure.
Mom and dad get to keep taking the distributions for their entire lifetimes. And then when are they going to die?
Right.
I mean, is it 10 years? Is it 15? Is it 20 years?
Right.
It's a little hard for a 40 or a 50-year-old to be really inspired knowing mom and dad are getting all the perks, but the 40 or 50-year-old's the one running the company.
Right.
It's a little hard to keep it going like that.
Yeah, I personally believe with family and privately held companies, absolutely, but honestly, even with key employees, if you've got somebody that wants skin in the game, I mean, you've got to keep them committed in some way. You can go far in incentivizing production with competitive financial compensation models for sure, but it is nice to have equity.
Having
is
equity.
Nice.
I always, my rule of thumb for the work that we do is I want to try to help the owners make sure that the right people are running the company and have the voting power.
Right.
It doesn't have to be sold off because people are fighting.
Right.
And if there's a young person there that isn't family, but they should be a stockholder, to try to find a way for them to become stockholders, and then try to do it in such a way everybody loves each other when it's all said and done.
Right. Yeah. And that last one's important. It absolutely is.
Yeah, that's the one that can be really dicey. I got to tell you a funny story though.
Please do. Yeah.
I worked with a company that had the father, tough father running it. Brother A in Nebraska, brother B in Arizona. the two brothers don't get along.
Sure.
And they had an operations guy in the middle that wasn't family, that was fantastic, and he was key to running and operating the business. So my suggestion to the dad was they've got to find out a way to allow that key person to own 20%.
Sure.
And I wanted it not to be 5, and I didn't want it to be 10. I wanted it to be 20. So the boys would be 40-40.
Sure.
So if one of them really got out of hand, the other two could make a tough decision.
Right.
You need 60%, right? To be able to really call the shots on a liquidation or a sale or something like that.
Absolutely.
So it made perfect sense to have that COO own 20% of the company, and he was a good guy.
Good.
And I got fired. The dad didn't like what he heard from me. But
I was going to say you worked yourself out of a job. You did what you were supposed to do and moved on, right?
Yeah. I hate if something like that happens. I hate it because I'm working so hard to try to do what's for the greater good of everybody, you know, and then just have the ego or the pride of a father just say, nope, can't do it. But anyway, let's talk a minute about the transition planning from a tax standpoint.
Absolutely.
The state of Nebraska has some really good packages to help save capital gain tax if you sell a business in Nebraska. Talk about that for a second.
Yeah. So the state of Nebraska, if you have a corporation where you're selling stock and you acquired that stock as a condition of your employment and or while you were employed by that corporation, there are some tests that have to be met for the corporation specifically. For example, the corporation needed to be in business for at least 3 years in Nebraska prior to you selling your stock. It needs to have at least 5 or more shareholders. One single shareholder or group of related shareholders can't own more than 90% of the stock at the time of the sale. But anyway, Nebraska-based corporations, when you sell your stock and you realize a capital gain, the state of Nebraska has this special capital gains exclusion, is what they call it. And in a nutshell, the capital gains on the sale of the stock of that eligible Nebraska corporation are just totally exempt from state income tax in the state of Nebraska. So,
and the state income tax today is what?
Today it is 5.2%. I'm glad you asked because the state of Nebraska is getting better tax rates.
It was 7.65, wasn't it, or something like that? No, 6.8.
6.84.
84.
Yep,
Yeah.
You got it. So it went from 6.84 to 6.64 to 5.84 to 5.2.
On its way down to 3.8?
3.99.
3.99. Okay.
Yep. So 5.2 this year. 2026, it'll be 4.55. 2027, 3.99. And that's where it'll stop.
So let's say, for example, let's keep the numbers easy. If I sell a company for $1 million and I have 500,000 in basis,
yep,
I'm going to pay that 5%, would you say 5.8?
5.2.
5.2% on 500,000.
Absolutely.
So it's not a capital gain rate. It's an income tax rate in the state of Nebraska.
Yep. So even though Nebraska calls it a special capital gains exclusion, Nebraska doesn't have a capital gains tax. It's all just income tax.
Income tax.
Yep.
So you have to have one person that's not family, right? You got to have one shareholder that's not family. There's got to be 5 shareholders involved.
There's got to be at least 5 involved. And no single shareholder or group of related shareholders are allowed to own 90% at the time of the sale. So yeah, in this case, if you had a family, let's say you've got 4 family members and 1 unrelated. The 4 family members cannot own 90% or more collectively at the time of the sale.
Okay. So anyway, if you do it right, folks, you can eliminate the state income tax on any gains that you have when you sell your company. Now, let's talk a little bit about installment sales that involve a stock redemption.
Sure.
Versus an installment sale that involves a cross purchase where you're buying assets.
Absolutely.
So what I'm talking about, for those of you who don't know, a stock redemption is when the corporation itself is the buyer and the corporation is buying the stock and bringing that stock back into the corporation. That's a stock. They're redeeming the stock. A cross purchase is when you have an individual out here buying the stock, and typically they don't buy the shares, they buy the assets. And why don't you talk a little bit about the difference between those? Because that's super important from a tax planning standpoint too.
Yeah, absolutely. So when you sell stock, if you're the holder of the stock, for example, and the corporation either redeems your stock or let's say you sell it, the IRS says the sale of stock is a capital gain. And for capital gains, the IRS, if you decide to carry the financing, seller finance, the note, and you elect to collect installments over some set period of time, the tax code allows that you report that capital gain on the sale of your stock pro rata as you collect the installments.
So when let's say it's a 10-year installment.
Sure.
And you're going to get $500,000 a year.
Yep.
What the IRS will do is they'll look at the total capital gain basically and divide it over 10 years.
In that scenario, yes.
And have you recognize the capital gain 1/10 for each year over a 10-year period.
That's exactly what I'm saying. Yep.
Okay.
Yep. So if your capital gain in that sale was say $200,000 and your proceeds that you collected were 1/10 a year for 10 years, I'd go 1/10 of 200,000 is 20,000. So we'd go 20 grand capital gain year 1, year 2, year 3. Hell, let's say we get to year 9 and there's no prepayment penalty. Let's say your kids have got enough cash in the bank to just pay you off, and so they give you $1 million in year 9. Well, so that million is now 1/5, and so 1/5 of 200,000 is 40 grand. So
Gotcha.
that's the ratable reporting that happens.
Okay. So how often do you see that kind of a deal happening?
Well, so with families, quite a bit, because you like to set up your family for success. You like to give the exiting family member who hopefully set you up to succeed and gave you the keys to a car that's running well. The capital gains treatment are lower tax rates, and so giving that exiting shareholder capital gains allows them to save. But in unrelated situations, almost never, because there's competing interest. And those competing interests are, if I am the buyer and I buy your stock, my purchase of your stock just adds to my basis. I don't get any immediate deduction. When I sell, it'll help me reduce my capital gain, but I don't get anything right now.
If you buy stock.
If I buy stock, correct.
So if your company's worth $20 a share, each share you buy, you're going to pay $20 for it, and then you're going to own all the shares of the company.
Yep.
Okay.
And it's just going to sit as my basis until I sell, but I don't get any deduction for it.
Yeah, no income tax benefit of buying stock.
Right. Now,
however,
contrast that with purchasing assets. So if I purchase assets, I can start amortizing intangibles that I purchase or depreciating fixed assets that I purchase. So if I purchase,
like for example, manufacturing company, they got a bunch of machines in the back. What?
Yeah, so I get to as the buyer of the, if you're the seller and you're selling me your company, and I negotiate that I want to buy your assets, and I go, hey, I'm going to give you $1 million, but the only reason I'm giving you $1 million is because I think your equipment is worth $1 million. If I purchase your equipment for $1 million, the IRS says that I get to depreciate that equipment,
even if it's 10 years old.
Yeah, even if it's 10 years old, it's brand new to me. So, and the silver lining, especially with One Big Beautiful Bill, is twofold. One, equipment is a 5-year depreciation life. So if I bought $1 million worth of equipment, I get a $200,000 deduction a year. But if I opted to, under One Big Beautiful Bill, I could elect to claim bonus depreciation of 100%. So I could technically write off that $1 million in the year I purchased the equipment from you and put it into service. Versus if I bought it for $1 million, if I bought $1 million of stock, I don't get any immediate deduction. I'm out the $1 million and it just adds to my basis.
Well, and typically you'd set up a new S corp for that or an LLC.
It depends on what I'm buying, but I would absolutely set up a new entity for sure.
Because you don't want to pick up any liability from the
Correct.
company that you just bought.
Yeah,
You want to have a new entity that takes over that equipment.
Yeah, and for a lot of good reasons too. Mostly liability related, but you set up, call it a new LLC to purchase the assets. It's a clean break. It's a new TIN. You're a brand new entity, so you don't inherit any of the liabilities of the former entity, and you don't own the assets personally. So that when you finally commence your own operations, you're in your own entity. Your operations are isolated to your LLC. You protect your personal assets in that case also. But I'd like that the emphasis would be on competing interests especially when unrelated parties are involved. Seller doesn't want to sell assets. Seller wants to sell stock. And the reason the seller wants to do that is, number one, the seller gets capital gains treatment on the sale of their stock. And then number two, if the seller sells assets, they have to report depreciation recapture on the assets that they sold, and it's subject to the higher ordinary income tax brackets. So that's the competing interest is buyer, I want to buy assets, I want the depreciation, I want it now. Seller, I don't want to sell assets.
You have to recognize it right there. So if they buy stock, then tell me again the how's that's better for the seller?
If the seller
it's just
sells
straight
their
line
stock,
capital gain.
Correct. Yep. Yeah. And you know what, Dave? The other point I should make is since we've talked about the installment basis, when you sell stock, the IRS says that capital gains can be prorated and deferred as you collect the installments. On the contrary, if you sell fixed assets that have been depreciated, the IRS says that you have to depreciate or you have to recapture the full amount of the depreciation on the assets that you sold in the year you sell. Now, anything above and beyond that, you can report on the installment basis.
So say that last part one more time.
Absolutely. Yeah. So if the seller sells fixed assets that have been depreciated, and let's put some numbers to it. Let's say I've got $1 million worth of fixed assets that have been fully depreciated. So I've got $1 million of accumulated depreciation. If I sell for, let's say, $2 million and I don't collect any of it, I've deferred my installments until next year. In year one, in the year of sale, the IRS says I am legally required to recapture and report $1 million of depreciation.
Year one.
Yep.
Yeah, boy, that's
the other $1 million
really
could be deferred and reported on the installment basis. But it's also $1 million of ordinary income at that, all in year one. So yeah, it's I've seen it happen before, and it was a very tough pill to swallow for, fortunately, the other party. They weren't as well represented.
What in the time we have left, let's talk a little bit about, typically a person that owns a company also has a separate LLC that owns the real estate.
Absolutely.
Or you might have people that have, a variety of real estate properties and numerous LLCs. Is there anything with this depreciation that has changed for people that are buying rental commercial real estate properties that they either rent to the company?
Sure.
Or
that's a great question, and it's one that we are doing a ton of planning on right now. And honestly, we could talk for another hour on, but I'll say it out loud, and you stop me as I go. But when you have a piece of rental property, whether it's residential or commercial, whether it's rented to unrelated parties or if it's owner occupied, the IRS says that you get to start depreciating that piece of property. And mechanically, the way that looks is you buy a piece of property, the IRS says you have to assign a portion of that property's value to land, and then the other portion to the actual building. The land is not depreciable. You don't get any tax break from it. The building is. Now, if it's a piece of residential property, you get it depreciated over 27 and a half years. If it's commercial, 39 years. Now, one of the things that the One Big Beautiful Bill made more attractive are cost segregation studies. A cost segregation study is when you bring in a team of engineers and they analyze the components of the building that you purchased. And their goal is they come into the property and they go, the building structure that you paid, let's call $1 million for, isn't worth $1 million. It's worth, say, $800,000. But internally, its components, the furniture, the appliances, the light fixtures, plumbing fixtures, ceiling tiles, carpeting. Let's say those might be $200,000. Their goal is to segregate the cost into these different asset classes that have a useful life of 20 years or less that are eligible for bonus depreciation. And so in that scenario, you buy, say, a $1.1 million property, $100,000 is land, not depreciable, $1 million is the building. But instead of saying, hey, we're going to depreciate this over 27 and a half or 39 years, we get an engineer in and they go, hey, we've got $200,000 worth of components that qualify for bonus depreciation. We get a $200,000 bonus depreciation deduction in year one.
Is there a rule of thumb to where you could say 20 to 35% of the building and its contents you can put in the bonus depreciation?
You're spot on, sir. Yeah. So we've been doing quite a few of these lately. So my team has just a lot of good contacts in the engineering space for this. We don't personally do it. We have been getting benefit estimates back and results back where it's closer to that like 18 to 25% range.
Okay.
But yeah, that rule of thumb holds up pretty well.
All right. Well, so we're going to wind up here. Anything else you think business people should know about the new tax code?
Yeah. The concluding comment I'd make on that, the real estate segment quick, would just be if it's owner occupied, the loss from the bonus depreciation would more than likely be deductible. If it's a short-term rental that you're actively involved in, that loss is more than likely deductible. But if it's a long-term rental, the IRS does impose limits on the deductibility of losses. More specifically,
define loss.
So if your rents collected less your expenses create a loss on your rental property, and more specifically, that if we do like bonus depreciation, it creates a $200,000 deduction. We're going to have a big fat loss.
Yeah.
And we want to be be able to write that off. So don't just do it.
On paper,
consult your
lose.
CPA.
Yeah, you want to pay the least amount of tax you can. So
absolutely.
However you can configure it so that you show a loss, that's
right.
a good thing.
But you have to be owner occupied or actively involved in a short-term rental. If it's a long-term, the IRS is very strict. They say that the deductibility of losses, in order to qualify, you have to be a real estate professional.
Oh.
Which is defined as somebody that works 750 hours in real estate and earns at least half their income in real estate. If you don't lose the loss. It gets suspended.
They just spread it way out.
Yep. You get to use it if you generate sources of passive income in a later year or in the year you sell it.
So you got to keep track of it.
Yes. Now, to One Big Beautiful Bill, I would say that the key takeaways would be the estate tax has gone way up, and I'm happy that it looks like it's here to stay.
Yeah.
Right. I can knock on wood.
Depends on whether Gavin Newsom becomes the next president.
Right. So from a tax planning perspective, we like to, and so do you, Dave, we like to manage tax and cash flows. And the idea is, how can we save tax in the short term and in the long term? And One Big Beautiful Bill slash tax rates, it's maintained inflated standard deduction amounts. It's got new standard deduction amounts for seniors. It's reduced using the senior standard deduction. It's made it more likely that seniors will pay less on Social Security. For business owners, it's retained a qualified business income deduction. It's allowed for bonus depreciation. It's made Section 179 permanent, which is another form of accelerated depreciation. I guess in a nutshell, more than anything, is it feels like it's given me more tools in my tool belt to save you tax now and over time. And then when you pass away, also allow the transfer of wealth to happen in a tax neutral or efficient way.
All right. So do you know of anybody that would be a good recommendation for a good CPA?
Good recommendation for a good CPA. Oh, so the biggest referrals we get at our firm.
Well, I heard there's a guy named Doug Morris.
I think so.
Yeah.
Yeah. And tax season.
Where do you find him?
You find him in the Union Bank and Trust building off 144th and Dodge.
And what's the name of the company?
McFarland and Brocky PC.
Do you happen to just know their phone number?
I think it's 402-341-9441.
Okay, folks, let me just tell you, I would not have asked him to be here if I didn't think he was top-notch, high quality. If you run a business and you need accounting help, call Doug. He does an amazing job just keeping all my stuff moving in the right direction. So I know he'll take care of you too. Thanks for being here.
Yeah,
really
absolutely.
Appreciate it. I think this is a conversation business people needed to hear.
Absolutely.
And, there's a lot of mechanics that go into buying equipment versus selling a company and all these issues that you have to plan ahead for. So make sure you take the time to do that and surround yourself with people like Doug to help you get it done right. All right, I'm Dave Nabity, Nabity on Business. Thanks for watching.